Welcome to our session. Now, so far what we have learned in corporate finance, we learned how to look at what do you call it as an annuity, how to look at perpetuity. If there is perpetual cash flows and you got to make an investment today, what is the amount of investment that you got to make if you are going to get a fixed perpetual cash flow or even a consistently growing perpetual cash flow? Or what is the investment that you got to make if you are trying to buy an annuity, a straight line annuity or even a growing annuity? From there we moved to something called as the, because to sort of look at the perpetuity and annuity part of it, we did touch upon, or we did go a little bit, try to understand a little bit on the time value of money. So what did we say? We said discounting. When we looked at perpetuity or annuity, annuity for a particular kind of an investment. So what are we looking at? We are saying that the money that you're going to get tomorrow, what is the value of that as of today? That's what we were trying to do. We thought of time value of money. Because we go back to the same basic concept what I talked to you earlier, that what you can buy with a certain amount of money today, you will not be able to buy the same product 1 year later with the same amount of money out there, because the value of money keeps depleting. So that is where we said time value of money. Why? Inflation, lot of other reasons. Let's not get into that. So that is where we said we discounted. Discounted based on what? Based on your expected return. Now, will the discounting rate be the same across all possible investments? Well, no. Because your expected return on an investment varies depending on the risk factors and the time factor. So because your expected return on a particular investment varies given the risk factor, etc., your discounting rate will be your expected return. When we did the bond valuation, we saw that the bond has a coupon rate of 8%. But currently, interest rate prevailing in the market is 10%. So what is the rate at which you will discount the coupons that you are going to get if you are to buy that particular bond in the secondary market? You will discount it at 10%. Because why? The current discounting rate in the market or the current interest rate prevailing in the market is 10%. The bond might have a coupon at 8 because bond was issued some 3 years back or 4 years back. Today, the expected return is 10% given whatever your inflations and other things out there and the risk factors. So given the expected return of 10% today, so what happens? Your discounting rate becomes 10% out there. So discounting rate becomes your expected return. So will it vary? Yes, it will vary. Will it vary with the instrument? Yes, it will vary with the instrument. More risky instrument. Supposing I say that you are going to invest in a debt instrument out there, a fixed deposit or whatever it is. So what happens? Your expected return will be about 8%, 9% as of today. 9% is too high, it's 8% around. So discounting rate is 8%. Supposing I say that no, I am going to invest in mutual fund, equity based mutual fund out there. Then what happens? The risk factor is high because certainty of getting return is not is not very high, or is not 100% like what you see in a fixed deposit. So what happens? To compensate for the risk, your expected return will increase. So to compensate for the return, when your expected return increases, then what are we looking at in that particular case? So what happens? Your discounting rate for that will be higher. So we learned all those basic aspects out there. From there we move to valuations of bonds and equities, where we use the concept what I talked about just now. Now I come to the last aspect of the investment part of it. As you can see on the screen, we are looking at, I know how to calculate the value of perpetuity, I know how to calculate the value of growing perpetuity, I know how to calculate the value of annuity, growing annuity, I know how to calculate the when it is equity, I know how to calculate because I use dividend discount model, I am discounting all the dividends out there, bonds, I am discounting all the coupons out there. zero coupon bond, no coupons, I am discounting the value that I am going to get at end of a particular period for that many periods out there depending on my discounting rate, and so on and so forth. Now, how do all these cascade into what is called making an investment decision? Now what happens? Where am I going to use all this? Now, as an entity, I need to make investments. I have multiple project options out there. I need to make my investments out there. When I need to make my investments out there, I am looking at what is called as the best possible investment option where I have to put in my money. So, what are the ways in which I can evaluate what is called as the best possible investment option? And that is what we are going to see as of now, making capital investment decisions. Now, do we use the concept? Yes, we use the concept of valuations, we use the concept of time value of money. Simple, we use the concept of time value of money, that is what is called as discounting in that case. Now, to start with, one of the first and foremost ways of making the investment decisions is what we see. We use what is called as the basic NPV rule, net present value. I talked about it. What is net present value rule? I have a cash outflow today. I am going to get cash in the next 2 or 3 years. That is, get cash means inflow of cash in the next 2 or 3 years. All that I am going to do is, in the cash that I am going to get in the next 2 or 3 years, I am going to convert it to the value as of today. I am going to convert that cash, what I am going to get, the inflows, what I am going to get over the next 3 years, to a value as of today. Then I am going to compare the value of outflow plus and the value of inflow as of today. If the value of inflow is more as of today, I go ahead with the project. It's a positive NPV. If the value is low, I don't go ahead with the project. So what do? That is what we are looking at in this particular case. Exactly what I said is depicted in this slide. Now, that is, it uses cash flows. It uses only cash flows from the project, and it looking at discount rate depending on your expected return on the project. How do we calculate the expected return? You have to wait. We'll go to the next part of the course, and then we'll sort of worry about how do we look at that particular aspect out there. Now, reinvestment assumption, that is NPV, assumes that all cash flows can be reinvested at a particular discount rate. That is basic assumption what we basically make out there. That is NPV rule. I mean, in the sense that total PVs of cash flows, estimating NPVs is basically what happens is, in this particular case, we rank them and choose, etc. And the slide is pretty self-explanatory out there. Minimum acceptance criteria, NPV should be higher than 0. That is, it should be positive. Now, let me take a small example and try and explain it out there. Let me take a small example and try and explain it. Imagine today, as of today, that is what I would say, year, in this particular case, year 0. I make an investment out there. I make an investment of 1 lakh. Sorry. Now, year 1, year 2, year 3, year 4. This is negative investment I made. I am going to get, year 1, I am going to get about 20,000. Year 2, I am going to get another 30,000. Year 3, I am going to get 40,000. Year 4, I am going to get another 30,000. So, this is the cash flows what I have. Now, question is, should you invest in this project or not? You can compare it. You can have one more project with again another kind of cash flows out. You can compare it also. You have another project. This is option 1. Let us say option 1. Let me use another color for option 2. Option 2, you have the same 1 lakh out there, cash outflow. I have a different cash flow stream. The cash flow stream is 40,000 in the first year, 30,000 in the second year, and then 20,000 in the third year, and then 20,000 in the fourth year. 50, 60, 70, 80, 90. and then 1,10,000. In this particular case, it is 50, 50 plus 40, 90, 90 plus 30 is about 120. So what happens? The total cash flows in this is 1,10,000, and then the total cash flows in this is 1,20,000. Now you would say, which project is better? Just by the face of it, the look of it, I would say, sir, go for project. Let me also term this projects as project A and project B. Sir, by the look of it, project A is better. Just go ahead with project A and finish it off, because you are getting 1,20,000, whereas in the other you are getting only about 1,10,000. Please note, the cash flow streams, for example, in the project A, the 40,000 rupees of cash flow, the bigger cash flow is going to come at a later stage, whereas in the project B, the bigger cash flows are going to come in the initial stage out there. So what happens? The value of this 40,000 rupees, what I am going to get, I am going to convert it to the value as of today, because as of today my value is going down. 1 lakh is what I am investing. So what am I going to look at? I am going to look at the present value of the cash flows. Let us say the discounting rate is about 10%. Now let us say the discounting rate is about 10% out there. Let me continue this in the next slide out there. Project A, project B. My year 0 is 1 lakh minus 1 lakh and minus 1 lakh. Now I am going to look at the PV is present value at 10% for both the projects. Present value of 10%. So in year 1, the present value, year 2, year 3 and year 4, the present values of it. What is the year 1 cash flow for project A? 20,000 for project A. I am going to have the present value of it, 20,000 into 1 by 1 plus R. 1 plus R is 10% to the power of 1, because only it is basic. How am I going to do? I will say right here 20,000 into 1 by 1 plus 10% to the power of 1 out there, because it discounted only for 1 year. So if I do that, what is the value, Suhail?
18181.
18181. So the value of that, yeah, am I right?
0.8 is there.
182. I'll just make this 2 then. Okay. So what is it? The value of the 20,000, what I am going to get 1 year down the line, as of today, discounted at 10% is 18,182. So what is the value of, what do you call it, as of 30,000? That is, I am going to say in this particular case 30,000 into 1 by 1 plus 10% to the power of 2. To the power of 2 out there. So what are we looking at in this? What is the value of Suhail?
24,793.
That is, the 30,000 what I am going to get in year 2 is worth only 24,793 as of today. Third year I am going to get 40,000. So it's something 40,000 into 1 by 1 plus 10% to the power of 3 in that particular case. Yeah, you can do it easily with the help of Excel. Yeah.
30,053. 300,523.
5.
Oh, sorry. 53.
53. 300,53. So 40,000 you are going to get in year 3. That's going to be worth only about 30,000 as of today. Last item. What is the last cash flow? Last cash flow is 30,000. 30,000 into 1 by 1 plus R to the power of 4 in that particular case.
20,490.
So what are the total cash flows out here? 6, 7, 8 and then 8, 6, 17, 17 plus 5 is 22, 22 plus 9 is 31, 3, 4, 4 plus 7 is 11, 11 plus 4 is 15, 1, 9, 9 plus 4 is 13, 1, 2, 4, 5, 6, 7, 8, 9, 93,518. My cash outflow is 1 lakh. My cash inflow, the value of all the cash inflows as of today is only 93. So what happens? My NPV is negative. 1 lakh minus 93,518. That is about
6,482.
6,482, negative 6,000. So this is a unviable project. Whereas I can look at project option B. Option B, 40,000 I'm going to get in 1 year. 40,000 into, it says 40,000 into 1 by 1 plus 10% to the power of 1 out there. What is it?
36,364.
Yep. The next cash flow I'm going to get is 30,000. That is to be discounted for 2 years. 30,000 into 1 by 1 plus r to the power of 2 in this particular case out there. Yeah.
24,793.
Same thing. Yeah, it is the same cash flow. Yeah, agreed. Next is 20,000. 20,000 into 1 into 20,000. Both are 20,000. 20,000 into 1 by 1 plus r, that is 10% to the power of 3. Yeah.
15,026. 15026.
Okay. Fourth year, 20,000. 20,000 to 1 by 1 plus r to the power of 4.
13,660.
Yep. Let's total this. It's about 7. 7 plus 6 is 13. 1. So 16, 17, 18. 18 plus 6 is 24. And then 5. 5 plus 7 is about 12. 12 plus 6 is 18. 7 plus 4 is 11. 11 plus 5 is 16. 16 plus 3 is 19. 1, 4, 5, 6, 7, 8. 89,843. So what happened? Even in this particular case, discounted and 10%, even this gives you a negative NPV out there. What is the negative? It gives you
10,157.
10,157. So what happens? Both the project unfortunately are not viable because it is giving you negative cash flow. That is the value of the money what you are going to get at a later stage. The value of it today is less than the investment. It is 1 lakh. So what happens? Both the projects in this case is unviable. You saw that the 40,000 what you get in the third year is worth only 30,000 as of today. Whereas the 40,000 what you are going to get in the first year is worth about 36,000. You can see that difference out there. That is what we look at. More number of years, more is the discounting what that happens out here. So that is one more aspect what I wanted to talk about. So NPV is this. As long as this is positive, for example, if one of it had been positive, then I would say I would go ahead with this project out there. So that is what we are looking at when we say in NPV rule out there. I've got some numericals also in that. So we accept a project only if NPV is greater than 0. In this case, NPV is less than 0. So we do not accept the project, either of the project out there. Okay. Next possible criteria for evaluation is what we look at as payback period out there, payback method. Payback method is very simple, normally not really much in use because it's very simple. It does not consider the time. Simple payback period does not consider what we call it as the time value of money. If I take the same example out here, if I go back to the same example out here, in this particular case, the payback, if I go by the payback period, I would choose a project which pays me back the highest. For example, this says 20 plus 30 is 50,000 in the second year, 50 plus 40 is, what do you call it, as 90,000 in the third year, and then this and then I need to get 1 lakh. So what happens? 3 years and 1/3 of the fourth year, that is in this project A, 3 years and 1/3 of the 3 years and 1/3 of the fourth year is when I get my payback in project A out there. Whereas when I look at this project B, 40 plus 30 is 70, 70, 80, 90, and then I need another 10,000 to cover this lag. So in this particular case, it is 3.5 years is when I will get the payback in this particular case. 3.5 years is when I will get the payback. So what happens? You will say, I will go with project A because project A gives me the money in a time which is less than the time that takes that project B gives me the return back. So I'll go with project A because project A gives me in 3 years and 1/3 of the year, whereas project B takes 3.5 years out there. Payback is nothing. You just add it, you don't consider the time value of money, and then you looking at the number out there, and that is all what we call it payback period. But payback period, do we use that payback period anywhere? Well, it is more of what you call it as learning at the stage, but in terms of use, payback period does not consider what we call it as the time value of money. It ignores the time value of money. So simple thing, normally payback period is just easy to understand, biased towards liquidity, agreed, but really not going to be of much use to you guys. So what happens? Next stage, what they do is they say that I will sort of use discounted payback period. So what did we do out here in this particular case? In the second sheet, I discounted it. Now I discounted it. Now once I discount it, I will say at what stage am I going to get this 1 lakh out there? Whether this is going to give me faster 1 lakh or this is going to give me faster 1 lakh. Unfortunately, in this particular example, none of it gives you that money. So I will not, none of it is. So what happens? I discount it and then I calculate exactly like the way I did out here in this particular case. I said 20 plus 30, 50, 50 plus 40 is 90. 90 plus another 10,000 I acquire to make this 1 lakh. So 30,000 in the last year. So it will take 1/3 of the year to get average. So exactly like that, I will count this 18,182 plus all these figures out there. At what stage do I reach that lakh is what I do in a payback period out there. So is discounted payback period used? Well, yes and no. By the time you calculate the discounting of the cash flows, you can as well do the NPV itself. So it's fine, it's used, but you can, it's more as one more reference point is what you will basically talk about. After discounted payback period, then let's go to what is called the next one is called IRR, the most important aspect out there. In this particular case, IRR is what you call it as is gives you the rate at which the return for the project is going to be feasible. That's all. IRR gives you the return, the rate at which the return for the project is going to be feasible, above which it's going to be feasible. Not rate is feasible, I'm sorry. The rate above a particular threshold above which the project is going to be feasible, below which it is not going to be feasible. That is, at what rate will this, what do you call it as the NPV be equal to 0 for this particular project out there? Supposing, let's say, the minimum acceptance criteria. In the sense, in this example, what we took out here, I discounted the whole thing at 10% and so on. Now we know that it is negative. At some particular rate, if I do the discounting, this NPV will be 0. Can I discount it at 7%? Will it be 0? Or can I discount it at 8%? Will it be 0? Whatever it is. That is what happens. At what is the minimum threshold where you make no loss, no profit on this particular project, at which you have to learn. Above which, if the return is going to be, for example, they say the project is giving a return of 15%. If they say the project is giving a return of 15%, I will look at the IRR for the project. That is the rate of return at which the project will have no loss, no profit. If the IRR for the project is, let us say, no loss, no profit of the project, where NPV is 0, is 12% is the discounting rate, then I will say 15%, yes, it is about 12%, viable, go ahead. Supposing the IRR for the project itself is 16% and the project is giving me a return of 15%, I will say, no, it is below the threshold. The project is not going to be viable, so it is not feasible at all. So IRR typically gives you the rate at which the minimum acceptance criteria, except if IRR exceeds. So when you come to IRR, normally what I say is the discount rate sets that NPV is at 0. That is, at what discounting rate is that NPV 0? That is that what is we call it as the IRR. That is where I said minimum expected criteria. If the expected return on the project is more than the IRR what you have got, that is where the discount rate, where the NPV is 0, if the expected return on the project is more, then what happens? You accept the project. That is, for example, let us take in this particular case, we saw that supposing I had discounted this everything at 5% or 6%, I would have got what is called as a positive NPV. If I discounted this whole thing at about 5 or 6%, I would have got a positive NPV. Beautiful. But if at some rate, maybe at 7 or 8%, the NPV will exactly be equal to 0. My discounting rate is lower. Why my discounting rate is lower? Because my cost of capital, the cost of my funds is lower at 5%, so I discount it at 5%. I discount it at my cost of my funds out there, because that is my minimum I have to get. Minimum expected return I have to get, because I have to meet the cost of capital. So if I discount it at 5% and I have a positive NPV, and my IRR is say 7% out there, that means what? It is my cost of capital is 5. The project is giving me minimum, it will actually give what is called as minimum. The project is giving me what do you call it as a 7% return, etc. So I will go ahead and accept this particular project, and so on and so forth out there. So typically IRR gives you some kind of a threshold out there above which you will accept the particular project out there, and then you have what is called as alternatively you will select alternative with the highest IRR out there. There are reinvestment assumptions and so on. And disadvantages, the problem is with IRR is some projects might have multiple IRRs, because there can be what do you call it as there can be cash outflows at multiple stages in the project. I can have a cash outflow in year 0, I can have a cash outflow again at year 2, I can have a cash outflow again at year 6, but there can also be cash inflow in year 1. So what happens? The sign plus and minus keeps changing. So difficult in such cases when we are looking at what do you call it as IRR. So what happens? You will have multiple IRRs out there. We'll take up some numericals out there. Consider a project out there. $200 is the outflow, $50 first year, second year $100, third year $150 out there. When I look at the IRR for this project, it is 19.44%. If I sort of calculate my discount it at 19.44%, my NPV is 0 in this case, exactly like this. So when we say NPV and IRR, which is better? Normally what happens? NPV IRR will generally give you what do you call it as the same kind of direction. Non-conventional cash flows, when signs change more than once, I will resort to NPV in this case. Mutually exclusive project where initial investment itself is different, risk profile itself is different out there, discounting rate itself is different out there, then you will have some issues in coming to what is the choice out there. Timing of the cash flows. So in such cases, I would prefer more to go with. In such cases, I would prefer to go more with NPV. Now, in summary, I would say just this: NPV and IRR. NPV, difference between market value and the cost. That is the present value of the returns and the cost out there. Accept if positive, reject if negative, no serious issues. IRR gives you a discount rate at which NPV will be 0. If what happens if your project is giving you a return which is higher than the IRR, accept the project. If your project is giving you a return which is lower than the IRR, don't even look at that particular project out there. IRR is slightly unreliable with non-conventional cash flows or mutually exclusive project. That is, if cash flows have changing sign, positive, negative out there, we will not look at IRR. Otherwise, we would basically go ahead with that. Now we will take up some numericals out there. I will take up some numericals and let us see if we can solve some numbers out there.